Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. In today's video, I will try to convince you that it is critical to go outside of Canada for your investing. Canada is only 3% of the world's capitalization in the stock market, while the US itself is 55%. Canada is mostly energy, materials, and financials, as you can see in the diagram on the right, with a sprinkling of others. It is limited in size and sectors. The world market, however, has all the sectors well covered and balanced. Just the US by itself is much better distributed than Canada and offers more investing opportunities. If you want to buy US stocks, you can do it from a Canadian brokerage. Use an ADR, which means American Depository Receipt, which are on the US stock exchanges for stocks traded elsewhere, such as BMW, Nokia, or Baidu. Or you can use an ETF. The EM here stands for Emerging Markets in one of mine. Or you can use mutual funds like Maurer International Equity Fund, which contain foreign assets. Some brokerages allow you to own stocks around the world directly. Please note that I am not advocating any of these assets, they're just the ones that I own myself. The pros of buying foreign stocks or buying assets containing foreign stocks are, number one, diversification, meaning that a change in the value of one asset will not be copied by another asset that is either of a different type or geographical location, where the economic situation could be different, for example. You also have more choices, and you have access to the remainder of the world's markets. Capital gains taxes on foreign assets are the same as on Canadian assets. The cons, however, are that taxes are high on foreign dividends. The government is encouraging you to buy local. The exchange rate on a weak Canadian dollar can be a con, but a strong Canadian dollar works in your favor. And there's a 2% margin on any currency exchange that is grabbed by the banks or by your brokerage. However, you can use Norbert's Gambit to get the real exchange rate at the time, as shown in an earlier video. Please note that many large companies, for example Coca-Cola or Microsoft, have branches and income from all over the world, and thus buying one company gives you coverage the world over. This is only for multinationals, but a lot of the companies that are on the stock exchanges do business all over the world. However, I have noticed patterns in the markets where there's a correlation between Canada, US, and the rest of the world. My personal anecdotal theory is the communication around the world allows investors in one location to know what the markets elsewhere are doing, and this changes the way they buy or sell the next day. So US investors think that if Europe is selling, they will too, and then China sells. I think there used to be less correlation in the past when the communication wasn't quite so instant. To summarize, to give you diversity, both by type of company sector and geographical, it is important to have some of your money invested outside of Canada. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.